Welcome to GPT News Channel. Here we report on the most current events and news from around the world. Stay up to date with the latest happenings with us. Last week, Silicon Valley Bank and Signature Bank failed, sparking panic among investors and customers alike. The collapse of these two banks, particularly Silicon Valley Bank, which caters to numerous startups in the tech industry, led to concerns about the potential knock-on effects for other industries. However, the US government has since stepped in, reassuring customers that their deposits are safe and that they will not bear any losses. While the collapse of these two banks has sent shockwaves through financial stocks, experts believe that the risk to the wider banking sector is low, as most banks are more diversified than Silicon Valley Bank and Signature Bank. In this article, we will examine what happened, what it means for you, and how you can protect your finances. Is your money safe? One of the biggest concerns for customers of Silicon Valley Bank and Signature Bank was whether their money was safe. However, the US government has long guaranteed bank deposits under $250,000, meaning that the vast majority of bank customers have nothing to worry about. While both Silicon Valley Bank and Signature Bank had customers whose accounts held amounts exceeding the $250,000 level, the Treasury Department, Federal Reserve, and Federal Insurance Deposit Corporation, FDIC, took action over the weekend to ensure that even these customers would not lose their money. President Biden has reassured Americans that their deposits will be there when they need them, regardless of which bank they use. That being said, if you do have more than $250,000 in cash lying around in a single account, now may be a good time to think about diversifying. The FDIC insures up to $250,000 per person, per bank, and per account type, which means that you can spread your money around between accounts without exceeding the insured limit. If you have a complicated tangle of joint and individual accounts, you can use the FDIC's Electronic Deposit Insurance Estimator tool to get a better idea of whether or not you're fully covered. It's important to note that the collapse of Silicon Valley Bank and Signature Bank was an isolated incident, and that the risk to the wider banking sector is low. While investors have been waking up to the fact that many banks are riskier than they might look due to sustained losses on their investments in government bonds as interest rates soared, experts believe that most banks are more diversified than Silicon Valley Bank and Signature Bank. What industries are hit? Silicon Valley Bank is a crucial lender for early-stage businesses, so its collapse led to fears about a knock-on impact to many other industries, from climate tech to medical research. The company is the banking partner for nearly half of US venture-backed technology and healthcare companies that listed on stock markets last year. And although the UK arm of Silicon Valley Bank was small with just over 3,000 business customers, its collapse would have created a serious risk to some of our most promising companies in technology and life sciences, UK Chancellor Jeremy Hunt said. One company that was caught up in the fallout was US-based online crafts marketplace Etsy. Over the weekend, the company said that it had experienced a delay in issuing payments to some sellers related to the collapse of Silicon Valley Bank. It said teams worked around the clock to implement a solution, and that it was able to issue the deposits on Monday. The potential impact of the bank failures on the broader economy is still unclear, but the tech industry is particularly vulnerable. Many tech startups rely heavily on venture capital funding, and the collapse of a key lender like Silicon Valley Bank could lead to a slowdown in investment and innovation in the sector. Another concern is that the bank failures could lead to a broader loss of confidence in the banking system, particularly among smaller lenders that are already struggling with mounting losses from bad loans. Overall, the fallout from the bank failures underscores the fragility of the global financial system, particularly in the wake of the COVID-19 pandemic. With interest rates rising and inflation on the rise, investors are increasingly nervous about the prospect of a new financial crisis. What does this mean for the global economy? While the collapse of SVB and Signature Bank may have had a significant impact on the banking industry, the broader economic impact remains unclear. In the short term, the failures of the two banks are likely to lead to increased caution among lenders, who may be more reluctant to provide funding to riskier industries. This could result in a slowdown in the economy, as businesses struggle to find the funds they need to grow and expand. However, some analysts believe that the impact of the failures will be relatively limited, and that the wider economy will continue to grow at a steady pace. The banking sector has become more resilient in the years since the 2008 financial crisis, and regulators have been quick to take action to prevent any systemic risks. Furthermore, many businesses have diversified their funding sources, relying less on banks and more on other forms of finance such as venture capital or private equity. Overall, while the failures of SVB and Signature Bank are a cause for concern, they are unlikely to lead to a wider economic crisis. What should you do now? For most people, the failures of SVB and Signature Bank should not have a significant impact on their financial situation. If you have less than $250,000 in a bank account, your money is likely to be safe, as it is covered by the FDIC. However, if you have more than this amount, it may be worth considering spreading your funds across multiple accounts to ensure that they are all fully insured. In terms of investments, it is important to remember that diversification is key. While investing in individual companies or sectors can provide higher returns in the short term, it also carries a higher risk of losses. By spreading your investments across different sectors and asset classes, you can reduce your exposure to any one company or industry, and increase your chances of achieving more stable returns over the long term. Finally, it is important to stay disciplined and avoid making rash decisions based on short-term market movements. Investing is a long-term game, and staying committed to a well-thought-out strategy is the best way to achieve your financial goals. In conclusion, the failures of SVB and Signature Bank are a reminder of the risks that can arise in the banking sector, but they are unlikely to lead to a wider economic crisis. By staying informed, diversifying your investments, and sticking to a disciplined financial plan, you can help protect yourself from any potential fallout. Thank you for joining us on the GPT News channel. Don't forget to subscribe and keep up with our updates. See you soon!